What if tomorrow your bank, your company's bank, your country's banks just stopped lending? No new mortgages, no loans for small businesses, no credit lines, no rollovers, just not right now. It sounds extreme, but versions of this have already happened. 2008, in the Eurozone crisis, in many shocks since. Today, we're unpacking a big question. What actually happens when banks stop lending, and how does a credit crunch break an economy from the inside? Let's get into it. Think back to September 2008 after Lehman Brothers collapsed. Global lending markets froze. Banks stopped trusting each other. Borrowing costs spiked. Companies suddenly couldn't roll over their debts. Households found mortgages unavailable or unaffordable. That moment exposed something uncomfortable. Credit is not just a nice-to-have layer on top of the economy. It is the bloodstream. When banks lend, they finance business expansion, fund mortgages, smooth over cash flow, fuel jobs and investment. When that flow stops, even briefly, healthy companies struggle, families stall big decisions, and governments feel the squeeze. Today, we're going to explain how banks actually create money, show why they sometimes slam on the brakes, walk through how a credit crunch spreads step by step, look at what central banks and governments do to stop the system from snapping. Okay, here's the first twist. When you get a loan, the bank doesn't go into a vault, grab someone else's cash and hand it to you. It creates a new deposit in your account, new money, out of your promise to pay it back. This is called fractional reserve banking. Banks keep only a fraction of deposits as cash. The rest is lent out. Those loans become new deposits elsewhere, and so on. Result? Most of the money in the modern economy is created by banks when they lend. The system works beautifully. As long as there is trust. Trust that borrowers will repay, trust that banks are solvent, trust that banks can borrow from each other if needed. Break that trust, and you flip from we're comfortable lending to we're scared, we're pulling back. That flip is where a credit crunch begins. Quick but crucial distinction. Liquidity equals can the bank pay what's due today? Solvency equals are its assets worth more than what it owes overall? A bank can be solvent but illiquid, fundamentally fine but short on cash right now. Or it can be liquid but insolvent, plenty of cash short term but long term doomed. In a panic, no one bothers to sort that out in real time. If other banks, markets, or depositors doubt either, funding disappears. And when banks fear for their own survival, what's the first thing they cut? New lending. Banks almost never announce, "We're done lending. Good luck, everyone." Instead, it happens through tightening. Number one, capital constraints. If banks take losses on bad loans, falling bonds, real estate, their capital shrinks. Regulations say you must keep your capital ratio up. When it's hard to raise fresh capital, the fastest way is lend less. Number two, liquidity shocks. If markets or depositors pull money, banks hoard cash. The 2023 Silicon Valley Bank collapse was a perfect example. Digital age bank run, billions gone in hours. Lesson learned? When in doubt, stop lending, keep liquidity. Number three, rising interest rates. When central banks hike aggressively, the value of bonds banks already hold falls. Borrowers struggle more to repay. Risk of default rises. Response? Tightens standards. Fewer approvals. Number four, regulation plus fear. After crises, rules get stricter. More capital, more liquidity, more stress tests. Good for stability. Dangerous if it tips into overcaution. And pessimistic headlines, weak growth, geopolitical tensions, and even healthy banks think, let's only lend to the safest clients. Number five, credit rationing. Banks quietly start saying no to small businesses, startups, lower income households, while still lending to big corporates with collateral. The result? The most vulnerable borrowers get cut off first. All of this is rational from each bank's point of view. Collectively, it's how economies choke. Let's walk through the chain reaction. Step one, the first squeeze. Banks tighten standards, SMEs can't renew overdrafts, households can't get mortgages or car loans. Step two, businesses freeze. No funding equals no investment. Projects are delayed, hiring pauses, expansions shelved. Some firms start laying people off just to survive. Step three, households pull back. Fewer loans, higher rates, falling house prices. People feel poorer, they spend less, especially on big-ticket items. But remember, consumer spending is 60–70% of GDP in many advanced economies. So, when households retrench, the whole economy slows. Step 4. Macro damage. Lower growth, higher unemployment, weaker tax revenues, higher welfare costs. Governments struggle with bigger deficits just as they are expected to fix things. Step 5. Markets join in. As growth slows and defaults creep up, banks raise loss provisions, profits fall, stock prices drop, corporate bond spreads widen. That scares investors, which scares banks, which cuts lending further. And just like that, you've got a self-reinforcing loop. Less lending, weaker economy, more defaults, even less lending. If nobody breaks that loop, you don't just get a slowdown. You get a deep, persistent crisis. So what happens when policymakers panic productively? First, central banks flood the system, cut interest rates to make borrowing cheaper, act as a lender of last resort so banks can access emergency cash, use tools like quantitative easing, buying bonds to push liquidity into markets. This tells banks and investors there is cash. You don't need to hoard. But there are risks, asset bubbles, moral hazard, bigger inequality. Second, governments backstop and recapitalize, loan guarantees for small businesses, emergency credit lines. In extreme cases, inject capital into banks to keep them alive. That stabilizes the system, but taxpayers wear the risk. And politically, bailouts they're unpopular. Third, regulation. Smarter buffers, not blind brakes. After the chaos, regulators raise standards, add counter-cyclical buffers, stress test for shocks. The challenge is balance. Too loose equals another bubble. Too tight equals chronic underlending. Fourth, new tools. Fintech and digital currencies. Online lenders and fintechs widen access to credit, especially for SMEs. Central banks are exploring CBDCs as a direct way to keep money flowing. Promise more inclusion, faster payments. Risk new systemic and cyber vulnerabilities. Now, why does it matter to you? Okay, when banks stop lending, it's not just a story about the financial sector. It hits the small business that can survive a slow season, the family who can refinance their mortgage, the graduate who can get a loan to relocate for a job, the government trying to manage rising debt with falling revenue. Credit crunches are less about money disappearing and more about trust collapsing. The system works when banks trust borrowers, banks trust each other, people trust banks, and everyone trusts that in a crisis, rules are clear and interventions are credible. The real measure of a healthy financial system isn't how loud profits look in good times. It's whether banks are willing and able to keep lending in bad times without blowing themselves up. Because in the end, when credit stops, the economy stops. When confidence returns, growth returns. Thank you so much for watching. If you like this video, please do like and do subscribe, and let's build the bridges and not burn them. Thank you.